Can a single government decision ripple through entire markets, shaking billions of dollars in stock value overnight? You are about to discover how tariffs, seemingly dry policy tools, can ignite chaos or confidence across the global stock market. Let us begin with a moment from recent history. In 2018, the United States imposed tariffs on hundreds of billions of dollars worth of Chinese imports. Almost immediately, stock markets around the world reacted. Some companies lost billions in market value within days. Why did this happen? The answer lies in how tariffs strike at the heart of business operations, profit margins, and investor psychology. To understand the relationship between tariffs and stocks, first we must ask, what is a tariff? A tariff is a tax placed by a government on goods imported from other countries. It is meant to make foreign goods more expensive, giving an advantage to domestic producers. It may sound straightforward, but the consequences that follow are often complex and unpredictable. Imagine a US-based electronics company that imports key components from Asia. If tariffs are suddenly applied to those components, the company faces two choices: either raise prices for customers or absorb the costs and reduce its profit margins. Both options are bad for business, and investors know this. As soon as such tariffs are announced, traders anticipate lower earnings and often rush to sell the company's stock. Prices fall. The effect is immediate, emotional, and often brutal. But this impact is not limited to one company. If a whole industry relies on imports, then tariffs can trigger a sector-wide downturn. Consider the automotive industry. It is deeply dependent on global supply chains. A tariff on foreign steel or aluminum increases costs for car manufacturers in the United States. As costs rise, stock prices fall because the market sees declining profitability on the horizon. Sometimes the effect is even more widespread. When tariffs escalate into a trade war, entire markets can tumble. This is not just theory. It is exactly what happened during the United States-China trade conflict. Each new round of tariffs caused indexes like the Dow Jones and S&P 500 to swing wildly. Why? Because tariffs introduce uncertainty. And if there is one thing stock markets hate, it is uncertainty. Investors base decisions on future expectations. If a company is likely to face new taxes, supply chain issues, or customer backlash due to tariffs, its future earnings become harder to predict. That uncertainty leads to volatility, and in many cases, volatility leads to losses. Tariffs also affect global sentiment. If the world's two largest economies are locked in a trade dispute, it signals risk across all markets. Investors move money away from stocks and into safer assets like gold or government bonds. This shift causes stock prices to drop even further. There is another angle to this as well: consumer behavior. When tariffs raise the cost of imported goods, prices often go up for everyday items. This reduces consumer spending. And since consumer spending is a major driver of economic growth, any slowdown hits corporate revenues. This ripple effect can drag down entire stock indexes over time. However, not every company suffers from tariffs. Some businesses actually benefit. Domestic producers who compete with foreign imports may see a surge in demand. For example, if imported washing machines become more expensive due to tariffs, US-based manufacturers might see a spike in sales. Investors respond to this opportunity by buying those stocks, pushing their prices higher. But even these gains can be temporary. If retaliatory tariffs are introduced by other countries, exports from the benefiting firms may suffer. For instance, American farmers once saw a sharp rise in soybean prices domestically when tariffs hit Chinese soybeans. But when China responded with its own tariffs on US agricultural products, demand dried up. Stocks tied to farming and agriculture took a hit. The global economy is deeply interconnected. A tariff in one country can cause a chain reaction in others. Take Apple as an example. It designs products in the United States, but assembles them in China. If either country imposes tariffs, Apple's costs rise. Investors know this. As trade tensions escalated, Apple's stock price experienced sharp declines. The same principle applies to thousands of multinational corporations. Currency markets also play a role. When tariffs are imposed, affected countries may respond by devaluing their currencies to make exports cheaper and offset the cost of tariffs. This currency shift can have a direct impact on companies with global operations. A weaker currency can erode the value of foreign earnings when converted back into U.S. dollars. As a result, companies report lower revenues and their stock prices may fall. Tariffs can even influence interest rate policy. Central banks monitor inflation and economic growth. When tariffs increase prices, inflation rises. In response, central banks might raise interest rates to cool down the economy. Higher interest rates make borrowing more expensive for businesses and consumers alike. This dampens investment and slows economic growth, which often leads to stock market declines. Some investors try to profit from these patterns. They study trade policies, anticipate tariff announcements, and position their portfolios accordingly. For example, when rumors of steel tariffs begin to circulate, savvy traders may sell off shares in construction or auto companies while buying shares in domestic steel producers. But this is a risky game. The stock market is not always logical, and government decisions can be unpredictable. Large institutional investors and hedge funds often employ algorithmic trading systems that react instantly to news headlines. When a tariff is announced, these systems can trigger massive sell-offs within seconds. This creates a feedback loop. As stock prices drop, other investors panic and sell too. The downward pressure grows rapidly, turning a policy decision into a market shock. It is important to remember that tariffs are a tool. They are used to achieve political or economic goals. Governments may impose tariffs to protect jobs, punish unfair trade practices, or pressure other nations into negotiations. But the stock market reacts not to the intention of a tariff, but to its economic consequences. Sometimes tariffs are used as bargaining chips. A government may threaten tariffs to gain leverage in trade talks, only to withdraw them once an agreement is reached. These episodes cause extreme market fluctuations. Stocks fall on the threat, then rise on the resolution. This back-and-forth behavior reflects the nervous energy of a market trying to interpret political signals. There is also a psychological element at play. Markets are driven by investor emotion as much as by economic fundamentals. Fear of trade wars, declining consumer confidence, and media headlines can all amplify the impact of tariffs. Even if a tariff has minimal real-world effects, the perception of risk can cause investors to sell. Tariffs can also create long-term shifts in corporate behavior. Companies may relocate factories, diversify suppliers, or rework logistics to avoid future disruptions. While these moves are aimed at reducing risk, they involve upfront costs and delays. The uncertainty surrounding future tariffs can discourage long-term investment, slowing down innovation and growth. For shareholders, this cautious approach often translates into weaker returns. Over time, markets may adjust to a new tariff environment. Prices stabilize and companies adapt. But the initial shock, especially if unexpected, can be dramatic. This is why policymakers must consider not just the economic goals of tariffs, but also their potential to shake financial markets. Tariffs also expose the fragility of investor confidence. In a globalized world, stability matters as much as profitability. When businesses face unpredictable trade environments, their stock prices reflect that risk. Investors become cautious, reducing exposure to volatile sectors or markets. Let us not forget the role of media. News coverage of tariff policies can fan the flames. Headlines like "Trade War Begins" or "New Tariffs to Hit Consumers" can cause mass panic among retail investors. Social media amplifies these fears, spreading doubt across digital trading platforms. The result is often a herd mentality, where fear outweighs rational analysis. But there are also lessons in resilience. Some companies prove remarkably adaptable. They pass costs on to consumers without losing market share, find new supply chains, or tap into domestic opportunities. Their stock prices may initially fall, but recover quickly. These are often the firms that long-term investors seek out during tariff-induced downturns. Governments and central banks also play a balancing role. During turbulent periods, they may intervene with stimulus packages, subsidies, or monetary easing to cushion the blow. Such actions can calm markets and restore investor confidence. The stock market is a living, breathing ecosystem, one where every tariff leaves a footprint. So how do tariffs affect stocks? They increase costs, create uncertainty, shift consumer behavior, and trigger emotional reactions in investors. They can both harm and help different sectors. They influence global trade, monetary policy, and corporate strategy. And perhaps most importantly, they reveal how deeply financial markets are tied to the decisions made in government halls. Thanks for watching the video. Do not forget to like, subscribe, and share my channel. See you in the next video.